Yesterday, we met Mark, a stacker who, if the U.S. adopted Italy's taxing framework of registering all the gold you own and paying a 12.5% tax today, lest you pay a more punitive one tomorrow, and letting the government know what you have, well, today we meet John. And we're going to frame this in how the Netherlands is taxing unrealized gains and what would happen if the U.S. were to adopt exactly what's happening today in the Netherlands. So without further ado, let's meet John. John is 35 years old. Like Mark, he lives in Ohio. He's not a hedge fund manager. He's not a billionaire. He works a normal job. He contributes to his 401k and hopes that if he does everything right for 30 or more years, he won't be eating cat food at 75. John invests $12,000 a year into his 401k. It's allocated mostly to low-cost index funds, tracking the S&P 500, and some tech exposure through Invesco's QQQ, and tied to the NASDAQ 100. Nothing exotic, just standard American retirement planning. Historically, broad U.S. equities have returned about 8 to 12% annually over long stretches. Retirement planning depends on one brutally simple data point, and that is compounding. Principal, return, and time. And now, let's walk through John's life. Scenario 1. No unrealized gains tax. John contributes this $12,000 that we'd mentioned for 30 years. And let's say he's at the low end and only achieves an 8% annual return. His account grows to approximately $1.36 million. Now, that's not luxury yacht money. That's middle-class security. But the difference between retiring at 65 and working until your knees give out or until you die. So now imagine a Netherlands-style policy, scenario 2. In the Netherlands, policymakers move towards taxing investment gains annually, not sold, but under political pressure driven by inequality debates, fiscal strain, and the argument that asset holders had benefited quote-unquote too much. Imagine the U.S. adopts a similar structure. Maybe it starts only for the ultra-wealthy, in quotes. But markets don't operate in isolation. If investors anticipate annual mark-to-market taxation, required returns rise, valuations compress, and effective long-term returns fall. So let's assume John's effective return drops from 8% to 6%. Same contributions, same discipline, same life, but at 6%, John retires with roughly $948,000, and that is a loss of about $412,000. $412,000. Gone! Not because John made bad decisions, not because he panics in a downturn, but because compounding was shaved by 2%. Or roughly, he lost a third of the return. If effective returns drop to 5%, now let's say the broader market impacts, valuation compresses, and taxes drag lower long-term effective, and we go to 5%. John retires with approximately $800,000 compared to the $1.36 million. That's a loss of nearly $600,000. So more than $500,000. That's just not a rounding error. That is a life outcome difference. What does the almost $600,000 actually mean? At a 4% safe withdrawal rate, the $1.36 million produces about $54,000 a year in retirement income. $800,000 produces about $31,000 a year. That's $23,000 income gap. And every year for the rest of his life. And that's the difference between covering healthcare comfortably or worrying about every bill, helping grandkids with college or apologizing that you can't, retiring at 65 or 72 or never. And here's the political parallel. In the Netherlands, wealth taxation expanded under rising housing costs, asset inflation, post-crisis resentment, budget pressure after massive government spending. And in the United States, we have roughly the same. We have record federal deficits, rising inequality rhetoric, sky-high asset valuation, and growing calls to tax unrealized gains among billionaires during the Joe Biden administration. and proposals from Elizabeth Warren, and the framing is identical. Only tax the rich. But here's the part nobody says out loud. Markets are interconnected. If taxation changes required returns and at the top, it ripples through valuation multiples everywhere. And John's 401k is priced off those same multiples. There are over $35 trillion in the U.S. retirement savings accounts today. If average lifetime balances fall by even $300,000 to $500,000 per year, households due to compounding drag, that's trillions in lost retirement wealth nationwide. It's not redistributed, it's not reinvested, it's just simply never accumulated. And the silent nature of the damage is this. What makes this powerful politically is that the loss isn't visible immediately. John doesn't see the headline saying government takes $500,000 from Ohio worker. He sees slightly lower annual returns, slightly compressed valuations, slightly more volatility, and slightly higher friction. And 30 years later, his statement is lighter than it should have been. This is what is happening in the Netherlands. The question isn't whether America would start with billionaires. The question is whether the long-term structural impact would stay contained. Because when you tax unrealized gains, you aren't just taxing wealth, you're taxing time. And time is the only thing John has working for him. Thank you for watching all the way to the end. As always, take care of yourselves and each other and build that stack.